Hello, everybody, and welcome to another edition of the Premier Investments and Wealth Management Financial Program. My name's Doug Wagner. I'll introduce the gentlemen who are in the room with me in a matter of moments, but the first thing I want you to do is make sure that you open the browser, whether it's on your phone, your tablet, or your laptop. Open your favorite browser, go to premieriwm.com, click Get Started. Just answer a couple of questions after that, and Premier Investments and Wealth Management will provide you with a free Premier Vision document and a free appointment with which to sit down and discuss it with them. Do you know if you're ready for retirement? Well, if you're like many Americans, you don't, or whatever your financial goals are in the future. This is a way to get those settled. premieriwm.com, click Get Started, answer the questions, and they'll provide this document to you free of charge and a free appointment, too. You can also call to make your appointment at 800-383-6590. Now, introducing from the Forbes 2025 Best in State Wealth Management Team, Vice President, Wealth Advisor, Premier Investments and Wealth Management, is a new sheriff in town, Elias Randel.
Doug, how are you?
Fabulous, and you?
I'm ready to do another show today. We got plenty to talk about.
That we do. Awesome day to be alive. Awesome day to be alive. Also with us here in the studio, over 21 years of experience in the financial services industry, an accredited investment fiduciary. He's the president, wealth advisor, Premier Investments and Wealth Management, and also the big kahuna. It's Roger Abel.
Thank you for the grand introduction again. Always much appreciated.
If you were in the phone book, you'd have like 5 A's in front of your last name. Be like A.
That would definitely make me first.
Yeah, it would.
I'm not always definitely first. I'm usually pretty close, but not always.
There you go. That's great. Hey, we appreciate you hanging out with us in the program. Today, we're going to talk minimum about 4 reasons why you can't time the market and 4 strategies you should consider instead. Tell you what, the volatility in the market, some call it chaos. I like the way you call it volatility. Maybe you hold up the publication that you have available for people as well that talks about volatility. Your guide to navigating volatility is what it is. And you can get that by going to premieriwm.com or calling them at 800-383-6590. You can't market time, no matter what you want to do. Really.
Well, the reason I opened this up while we were getting ready is I have the statistical chance of timing the market correctly all of the time. It's 0.0 with 245 zeros before the next number.
Wow.
So why try?
No.
And, there's a lot of reasons. And really, probably the number one reason that makes it difficult is volatility and randomness. Volatility doesn't, tell you it's coming. It just shows up someday.
Yeah.
There's really no way to predict this stuff. If you were able to predict it, it'd already be priced into the market. That's really what's happening. So I think one is volatility, shows up when you least expect it. And we're doing this show after really probably one of the largest volatility spikes in the last decade. There's an index out there called the VIX, and it spiked over 60 here last week, which is, pretty much unheard of. Came from about 13 to 60. And I think most people are probably aware of what's happening in markets and how fast they're moving. And that's what volatility is. It's just a measure of how fast things are moving in the market.
And it's amazing, too, because you start thinking about there was also another recent explanation of volatility is the Masters golf tournament. I mean, Rory McIlroy was like, and then he gives up 2, and then he picks up 2, and then gives up 2. It was just all over the place. So this is happening in multiple places in people's lives. You just can't ignore it, Elias.
No, you can't ignore it. And I think, you can try, and it's probably helpful if you try to block out some of those things. So the randomness of the volatility, like recently, let's just talk about the tariff, how this is all played out. How would anyone have been able to, one, predict the series of events, right? Because the market's kind of been reacting to headlines and things around the tariffs. So how would you have accurately predicted how all it was going to play out? Doesn't it seem like it's been kind of random?
You wouldn't be able to predict how it would play out, but you could have predicted that there were going to be tariffs. I mean, he ran on that and said there will be tariffs. I think what the market shock was what they expected to happen, and how severe the new tariff proposal was, has really sparked a lot of fear, because it wasn't just a 10% across the board tariff.
Yeah.
It was massively higher than what was expected. But also the reason guys like Tom Lee with FundStrat and FS Insight, they never believed it from day one. They said there's no possible way that this is really what the tariff is going to be. So that's the challenge to figuring out when to time a market, because not only do you have to figure out, what's happening, but what's real.
Right. And that gets to the second thing, is having no reliable predictive model that's out there, because it's like, this is sort of an unprecedented thing. Like Roger said, I knew there were going to be tariffs, but when they were set, against whom, how they're getting pulled back and they get reinstated. And then next, every news cycle is something that you just can't figure out.
Well, and even with, when do you remember what was the lowest close? It was like just under 5,000. Did it ever close under 5,000 points?
We didn't close in the bear market, went down a little more than 19, but never closed in bear market territory, which is really interesting.
Yeah, it is. And I think intraday trading, right? We did breach bear market territory, but just this morning, I was reading some research that our back office LPL puts out, and they're starting to talk about how you can make a case for the lows of the year being in, with the intraday trading went like just under 4,900 on the S&P 500. And I'm not making a claim that that is going to be the low of the year, but assuming it is, and how many people on those days, Roger, did you talk to? I know I talked to a few that said this is certainly going to get worse.
Oh, a lot. And here's the interesting thing. Thursday and Friday, that was a week ago. I forget the dates, but everybody knows what Thursday and Friday I'm talking about. The 2-day market decline was 10.5%. Fifth worst 2 days since 1950. Okay. There was still dip buying happening on Thursday and Friday. On Monday, which market went down again on Monday, JP Morgan put out a report that retail investors pulled out $1.7 billion on Monday.
From their firm.
So dip buying to selling, like getting out of the market, basically capitulation, like pain is so deep.
Yeah.
We can't take it anymore. And then what happened Tuesday? Face ripping rally.
Yeah.
5%. Yeah. Actually, it wasn't 5. It was like, what was the NASDAQ, 12?
It was
S&P
for
with
one
8.
day. It was a lot.
It was a face ripping rally. And that said, it's what we talk about. The best days likely come after the worst. I mean, when was the last time you remember a random summer day and the market just goes up? The market just goes up 12% for no apparent reason.
No.
No, that never happens.
That doesn't happen.
That only happens in really volatile market time.
But when is volatility kicked off?
Right.
By a spark up. Volatility is always kicked off on the downside. I mean, I can't remember a time when the market just went up 7-8% in a day after there wasn't downside volatility.
Yeah.
That'd actually be a good statistic to get, but typically volatility is kicked off by downside risk.
Right.
And then you get these great market days, and statistically, if you miss the 10 best days of the market, if you've missed the 10 best days, you give up 20% of your return.
Well, and it's interesting you bring up, so JP Morgan, right? They had some flows out of equities, I'm assuming, right? From their retail clients,
traders,
and probably a more active trading person would have an account with them, like more actively managed.
Not necessarily, just enough people hit the panic button.
So the interesting thing about that, the company, so I saw a recent chart from Vanguard, which Vanguard's pretty much popularized buy and hold investing, right? Jack Bogle's kind of considered the grandfather of that idea, just kind of the main person to really make that a very popular way to invest. And their flows had not changed. So there's still investors out there that were still exhibiting good investor behavior and that were buying and holding for the long term. So it's just interesting that Some firms had flows out, but then like Vanguard, they're just clicking away like they always do.
Yeah, and that makes sense because Vanguard doesn't really have they don't have a platform people go to Vanguard to sign up to actively trade stocks. That's not why you would go. You could do that, but that's not why you go to their platform.
Right.
You go to their platform to buy into the low cost, efficient, inexpensive model of investing.
Worried about the ups and downs of the market? You're not alone. When the headlines get loud and the numbers swing, it's easy to feel uncertain about your future. At Premier Investments and Wealth Management, we believe knowledge is power. That's why we've created a free guide to market volatility to help you understand what's happening, why it happens, and how to stay focused on your long-term financial goals. This guide breaks down the key facts, offers historical perspective, and shows you how a solid financial plan can turn market turbulence into opportunity. Whether you're nearing retirement, just getting started, or somewhere in between, clarity and confidence are possible. Download your free copy today at premieriwm.com or call us at 800-383-6590.
It's Roger Abel and Elias Randel from Premier Investments and Wealth Management on the Forbes 2025 Best in State Wealth Management Teams list. Check them out at premieriwm.com, premieriwm.com, or call today for appointment 800-383-6590. We're talking about 4 reasons you can't time the market and 4 strategies you should consider instead. I almost wish that Casey Mushrush was in here and give me a good 15 minutes on market efficiency, but you can 1 minute it for me because it's really a condensed, thick kind of thing.
Yeah, there's something called efficient market hypothesis, and basically it just says financial markets quickly and fully incorporate all publicly available information. And thus the reason nobody sees shocks coming, right? And the market is predicting them in the future. And I think a lot of people just think stock prices go up and they go down. I think what people need to recognize is the value of an individual stock, which correlates into an index, which is how most people would invest. It's all determined by future earnings. What are the earnings of a company? What do we expect the earnings to be in the future? And then there's a multiple applied to it. So, for example, if, let's say there's a company making phones and the phone is $1,000 and there's a tariff of 100%. So now that phone's $2,000. There's a choice to be made here, right? The consumer can bear all of the price increase. The manufacturer could bear all of the price increase or a combination of both. Well, if the manufacturer bears all the price increase, what happens? Their earnings go down.
Right.
If the consumer has to bear all the price increase, their earnings still go down because fewer people are going to buy it at $2,000. Thus, the reason you saw massive amounts of stocks that were down 10, 15, 20, 30% because of these tariff, the tariffs that were proposed. And now they've been scaled back. We see them coming back. Just remember, earnings is what prices the stock market. And that's always what kind of gets me when someone says, well, what if I lose all my money? Well, that means all the companies in America have earnings of 0. That's the only way it's priced that way, right? Like you have no earnings, 0, no future earnings, which means everybody's out of business. And it can't operate that way.
Right.
It won't operate that way.
It's interesting because we're talking about the 4 reasons, and we already hit number 4 a little bit earlier because we talked about the whole concept of people that are they can't take the pain and they're pulling out of the market, some of the retailers, because the idea of behavioral finance says that as people in the marketplace, we act inversely from the way that we should when it comes down to it. It's like when the market's low, you want to buy into it so you could buy when it's coupon clipping time and you can actually sell when it's high. I mean, it's kind of in the inverse of what we usually think, isn't it, Elias?
It is, and some of it's counterintuitive because a lot of the best times to certainly buy into the stock market are when there's the most chaos and uncertainty. And there's a couple things that I feel, at least I've been talking with people about when it comes to their psychology of their money, and I think a couple good reminders for times like this. So one, in personal finance, we call it anchoring, where anchoring is you see the highest account value you've ever had, and then the market comes down, right? Well, of course you want your account to always be the highest value
Right.
you've ever seen, right? And to grow from there. But as an investor, the more you can, and I don't say like detach yourself might be too strong, but just understand if you have a good long-term strategy, like really nothing fundamentally has changed about these companies and their ability to make money. So, and it's a fluctuation, right? Your account value is fluctuating, but that doesn't mean you're realizing any losses. Now, if you make a rebalancing mistake and you sell out of your stock portfolio, however much that represents for you, and when you're down 15 or 20%, now you're more at risk of not being able to recover and kind of ride the rally back up. So I think that's one thing I've been talking with people about. And then certainly for this tariff thing, if the more you can not let your political opinions kind of skew your view of the capital markets, the more successful you're going to be long term as well as an investor.
So I have 2 comments. One, on the psychology part. I kind of had this aha moment this year. I had an individual call me up on Friday when the market's just on Monday when the market's getting crunched the previous 2 Thursday, Fridays. He's like, hey, I think we should just put it all in bonds and wait for it to go down another 20%, and then we'd buy back in. And it dawned on me, his rationale for going to bonds or cash had nothing to do with preservation of capital, but actually greed, because he thought he was going to be able to buy back in at a lower price. Like, think about that. It wasn't, hey, I can't see it go down anymore.
Right.
I want to reinvest it at a lower price. And I told him, I said, well, this is on Monday. I said, we could do that, but I don't think you should. I said, what are you going to do if the market goes up 10%? Are you going to buy back in then? Once you're out, you're out. Sure enough, what happened on Tuesday? Went up 10. And I called him. I said, hey, do you still want to reallocate? Because if you want to, now's the time. No, I don't want to.
Yeah, but if you're really bearish on the market, you should sell the rallies, right?
Right.
Like, kind of, that might be an oversimplification, but that's probably something you should consider.
100%. The second thing is, you're right. You mentioned political biases. I think people need to look themselves in a mirror and tell themselves, I shouldn't have a partisan portfolio. It's 100% happening. I have family I work with. They wanted to become conservative in February, late February. So pretty good timings. They're just concerned about what's going to happen. Called me over the weekend. Do you think we made a mistake becoming conservative? I'm like, this is what you guys wanted. I didn't recommend any of this to you guys, but you want to have a partisan portfolio. Now it's the fear of missing out.
Yeah.
And likely they'd have just been in the same spot as they were if they wouldn't have done anything. But people shouldn't let their portfolios be partisan. That's one. And 2, right now is the biggest time you need to have a media filter.
Right.
And I had someone send me a video that said, hey, watch this. Give me your opinion from minute 12 to 38 minutes, 12 minutes to 38 minutes. And I just sent back, I said, no, thank you. They go, well, I wanted your advice. I said, I understand that. I only consume information from 4 places. And they're places that I deem to be nonpartisan. And in fact, actually, some are probably a little bit, but not much.
Right.
I looked up this podcast, and it doesn't matter if it was conservative or liberal, but it was one way.
Yeah, it was not centrist.
It was not even close. And this is the person that called me up and said, hey, did we make a mistake? And I just don't even know what to say.
Yeah.
Like, they're letting politics run their portfolio. For everybody listening, the stock market doesn't care if you're a Republican or a Democrat. It doesn't care. It cares about earnings, and that's it.
And I mean, in all reality, that's good recommendation for life period, because there are people, not only their financial thing is getting blown away, but their family life, their friends' life. I mean, all that's it's wrecking relationships because people are allowing this to get in the way of everything.
You watch Dave Ramsey, right?
Yeah.
He says this all the time. Who is in the White House is not going to determine how my life turns out.
Yeah.
We all did well under Obama. Everybody did well under Trump the first time. Everybody did good under Biden. Everybody will do well again. Like, if you're letting the person in the White House determine how your life goes, you need to have a look in the mirror and change what you thought. Because it's not. You're in control of your life and where it goes. Yeah, there could be things you have to react to and do, but should not be the person.
Can we just put that on loop and just play that the remaining 7 minutes of the show? That's like the most sensible thing that people have heard in a long time. Roger Abel and Elias Randel from Premier Investments in Wealth Management at premieriwm.com. Forbes 2025 Best in State Wealth Management Team. Just go to premieriwm.com, request an appointment online. They've got downloadable material, or you can call them for an appointment as well. 800-383-6590. That's 800-383-6590. So we talked about 4 reasons you can't time the market. And in the few minutes we have left, how about some 4 strategies you should consider instead? Let's start off with the thing prior to that, is that get yourself a financial plan, right?
So here's what's interesting, and we were just talking about psychology of investing. Well, when you look at the numbers, about a quarter of people, 25%, have done a financial plan, and 25% of investors feel very confident in their retirement and in accomplishing their goals. So I think that those 2 things are related, and here's what it's going to do when you have. I guess just when you understand your strategy, you understand the decisions you're making in the short term, and you feel good about your position for long-term success, you can just have more confidence, and you can also weather these storms better. Like, these times of chaos come up, and I would say most of our very good clients that are engaged in their financial planning, they understand the philosophy. And no one wants to see volatility in their portfolio, but I think they also have an ability to not let that drive their decisions.
Yeah, it's number 4, stay the course. And there are a lot of other things, too. Roger, I know in the radio show, a lot of times we have one person that continually gets in touch with us and talks to us about a single stock. But the other thing, too, is that if you think you're diversified because you've got all these different mutual funds, look inside them. Your financial planner should be looking inside them to make sure that it truly is diversified.
That's a really good point. And 2025 might be deemed the year of diversification. Because if you were diversified, if you've been diversified into asset classes like consumer staples or dividends, just not all S&P 500.
Right.
You've done okay. I mean, there's a lot of funds that are even on the year or positive. It's just not the S&P 500. And for the last decade, it's just been by large cap growth companies. That's it. And you did well. And ironically enough, we've been in a 0% interest rate environment for 20 years? Interest rates have been pretty well flat. Well, what thrived during that environment may not be the same asset classes that thrive in an environment north of 4%.
Yeah.
And we might have a prolonged higher interest rate environment. We don't know. But this year, if all you've done is about the triple Qs and you bought the S&P 500, you're getting whipped. In fact, we have a fun, someone asked why we have so much in this.
For one of the,
yeah. And, well, it happens to be positive year to date. That's why.
Yeah.
But it didn't look on a 10-year return. It doesn't look like, oh, this is awesome. No, it looks okay. Same thing, international. A lot of people have went away from international companies. Right. International's doing really well year to date. Will that trend continue? I don't know. But most people have had drastically less exposure to international the last 2, 3, 4, 5 years because of the massive underperformance. This year, diversification is winning. You're getting rewarded for a diversified portfolio, not just an S&P 500 portfolio.
Yeah. Makes sense. One of the other things about strategy you need to consider instead of trying to time the market is doing rebalancing your portfolio. We've got about 3 minutes left. I just got an automatic notification at the very beginning of April that had happened with mine.
Was that Mark?
What's that?
Was that Mark?
No,
this is for my.
Mark took care of my IRA, but my 401k did the automatic rebalancing right at the end of March. So it was like, yay, the perfect timing for that.
Well, and that's another thing you can control as an investor is rebalancing. So, and just think about the recent months here. And I'll talk through this through the lens of someone who is retired. Let's say you're retired and taking money out. And in February, right, all investors, we have choices where, hey, the market's doing really well. We're close to all-time highs. I take money out. Should I maybe sell some stuff that's up and raise some cash in my portfolio? And then from there, you kind of go to, well, either your greed kicks in, well, I'm going to just wait a little bit longer and see how high this can go before I do that.
Yeah.
Right? Or now the market's down, right? And we start making decisions that are fear-based. And if you weren't willing, if you didn't raise any cash when things were looking really good, I'm not sure how you're going to do it when we were close to a bear market territory. So if you put some rules in place for yourself about how you're going to rebalance and what you're going to do and be strategic about it, that's something that can really help you.
Yeah.
And just what you mentioned, like the only really investors that are getting really, really smoked this year are if you're in a lot of technology and all large cap growth. There are other asset classes that have done fine.
30 seconds.
Here's the best tip. Stop checking your account every day. It doesn't matter because you'll anchor yourself to it. One, check your monthly statement. If you have to check it, check once a month. Don't get caught into the daily volatility. And I don't know what the rest of this month has to hold, but at the end of the month, the market could be flat. It could be a little positive, could be a little down, but it's not going to be this massive, the way we're going, cross my fingers, it may not be this massive downturn everybody thought in the beginning of the month.
Right. Final thing is the 4 strategies you need to consider is dollar cost averaging, and that's something they can talk to you about when you call them at Premier Investments and Wealth Management to make your appointment at 800-383-6590 or go to premieriwm.com to get in touch. Make your free, no obligation appointment with Premier Investments and Wealth Management, named to Forbes 2025 Best in State Wealth Management Team. For Roger Abel, for Elias Randel, I'm Doug Wagner. We'll talk to you next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Forbes Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.